Hi, I'm Roger Montgomery from Montgomery Investment Management, and welcome to this week's Video Insight. Well, many of you know that 2016 was not a year that Montgomery would like to remember. If you look at this chart, you can see that the best performing stocks were those that we deemed to be the lowest quality companies in terms of their economics. And the worst performing stocks last year were what we regard to be the very highest quality businesses. We didn't lose money for our clients, but we didn't outperform the markets. In fact, the markets significantly outperformed us. The reason for that was what's known as the reflation trade. There were expectations that the global economy would start growing much more strongly, and that may be the case. And in anticipation of that, resource companies rallied very, very hard. You might remember that BHP was up 73% or thereabouts in the calendar year 2016, and Fortescue Metals Group was up over 230%. Now, Montgomery doesn't believe that the outlook for these businesses justifies such significant share price performance. In fact, we don't think they're very high quality businesses at all. Many investors believe that if a company's shares go up, it must be good, and if the shares go down, it must be bad. We know from history and also from our own longer term performance that that's certainly not the case. The banks also performed very well, and they performed well simply because there was an improved outlook or belief in an improved outlook for their performance. At Montgomery, we didn't concur with that market view. In fact, we think the outlooks for the banks are deteriorating. Now, recently that was confirmed. The quarterly announcements from all of the big four banks proved that net interest margins are under pressure, that delinquencies are rising, and that credit growth will be muted. Now, we believe this is cyclical, but the cycle, the deleveraging cycle that Australia is about to face, is going to last some time, simply because Australian consumers and households are already so highly indebted that they simply don't have the capacity to borrow more money. We also know from financial stress indicators that any increase in interest rates or any loss of revenue by mortgagees because vacancy rates increase or rents fall is going to put further financial stress on consumers, meaning that the outlook for retailers, the outlook for the banks is going to deteriorate even further. Our global funds and our domestic funds are now starting to show the benefits of this particular approach. The Global Fund for the 12 months to the end of April has generated a return of nearly 27% for its investors. Montica in the last 3 months has generated a return of over 11%. The Montgomery Fund and the Montgomery Private Fund are both now generating solid returns. This is not because of a change of strategy at Montgomery. It's simply because we believe that the reflation trade, the rally in banks and the rally in resources has simply run its course. At Montgomery, we don't need to change what we're doing. We know in the long run, by focusing on high quality businesses, that will outperform the markets. It's what we're doing in our global business, and it's what we're doing here in Australia. If you look at our returns, you'll see them starting to improve. And in fact, as I speak, both the Montgomery Fund and the Montgomery Private Fund have continued to perform very, very strongly just in the last couple of weeks. You can see from these charts that both the resource companies on this chart and the banking stocks on this chart are starting to roll over. You can also see that the outlook for retail stocks is starting to deteriorate. There's a very strong correlation between housing activity and renovation and addition demand. That also leads to demand for furniture and appliances. And so this chart shows that the deterioration in housing activity will ultimately lead to pressure on retailers as well. So while our cash balance has risen, we're in no rush to deploy that cash towards any retail stocks at the moment. Thanks for listening, and I look forward to seeing you next week. In the meantime, please continue to follow us on Facebook and Twitter.